Don't do it, guys. Don't place trades based on the information you see over here. This is for entertainment purposes only. Consult financial advisors and do your own due diligence before placing trades. Okay, let's go. What's up, guys? It's Sunday. Markets are closed. I'm up 39 cents on my account since yesterday. Huge. It's because of the Ethereum that I own over here. I don't trade cryptos. I just have it for kicks so I can see this during the weekends. Now, today is option day. I'm going to show you guys the type of options that I like to trade and how to place an order. Now, there are probably, and I'm sure there are many different videos out there that explain options way better than I do, but I'm just going to give you the take of how I look at it and how I think of them, and I might improvise a little bit on explaining them. So, if you want, stick around and check it out. Now, I saw that pre-market over here, gold and silver is trading already in Asia, so and that concerns me because I like to trade EXK. As you may know, never lost a trade on EXK. So I see that gold's up 69%, silver's up 81%. All right, hopefully that persists through tomorrow. Maybe we'll get a nice little pop. Um, EXK will probably reverse. My average price is like right here. It's 222. It dropped a little bit after market last Friday, but that's going to reverse hopefully tomorrow. We'll see another pop and we'll see what I'll do. I have a bunch of options trading running on it. I have $3,000 worth of collateral worth of options here for 12 contracts. I've sold 12 put options and I've sold two call options. And I'll show you what that means a little bit if you're wondering and you're not a pro. So, okay, here we go. Let's take a look at what that means. So you have four different types of options. You can buy or sell a call, or you can buy or sell a put. All right, and I'm gonna go through all of them to kind of show you what that means. So if you buy a call, okay, first of all, you can pick your expiration date. On the app, it's a little bit different, but on the website over here, you can pick the expiration date. Now, what that means is that when you pick a date, the contract that you purchase or sell, it's gonna either expire or execute on that date. Okay, depending on where the stock price happens to be relative to your contract. All right, so I'll show you right now. So let's say the first thing you can do is buy a call. When you buy a call, what you're doing is you're putting up money up front. Okay, so in this case, it's going to be $5 because it's 5 cents for per share. A contract is a minimum of 100 shares. One contract is 100 shares. So you're going to put up $5, all right? So you're paying $5 and you're basically betting that by September 21st, the price of EXK will be above 250, but actually your break-even price is a little bit higher, all right? So it needs to clear 255 if you're gonna make any money because you can factor in the oh, it says it right here, look, 255 if you want to factor in the price of the option itself, which you should obviously factor in all your expenses. So you need really the price of the option to go above 255 by that date. If it doesn't, the contract expires, you lose your $5. But if it goes to like 256 or above, the contract will execute. And what's going to happen is you're going to receive some money, all right? Because you're going to automatically purchase the option, a bunch of shares at 255 and sell them at 256. So you're going to get 1 cent per share, and you're going to collect the whole dollar in your pocket if I've done my math right. And if I haven't, if you're a mathematician or super experienced with numbers, let me know in the comments that I've messed my math up and we'll go back and fix it. No, we won't. But I'll say sorry in the next video, you know, it's cool. So over here you have the ask and the bid. So you can see for this contract right now, what that means is that people are trying to sell it for 10 cents. Look, 16 contracts are trying to be sold at 10 cents. and absolutely zero people are bidding up 5. Okay, so no one wants to buy that. Um, all right, that's it. Now, that's buying a call option. Here's what I'll do, all right? Here, here's what I'll do here. I'm gonna switch the scene to display capture. I know it might look a little bit weird for a second. And we'll just draw on the screen. Oh, that's neat. That's right. Okay, now, when you buy a call option, okay? So let's say this is your stock right here, and it goes out like this. Beautiful. And the stock price is over here. Let's say it's what is it? What was it? 216. All right, and this is 250. Gotta love it. It's great. So if it closes above this number, you make money. All right, basically that's it. Above 255, including the price of the option, you make money, pure profit from there. It's exponential. So if it goes to like, $3, you would make a lot of money. All right. Now, if it closes, what happens if it closes below? Okay. If it closes below, then the option expires, lose your money. That's it. Very simple. Okay, let's get rid of that. Now, what happens? Let's say you want to sell a call. All right, selling a call in Robinhood, you'd have to have the options there. You need 100 shares in order to have collateral for that sell. All right, so what you're doing, if buying a call means that somebody is promising you to sell 100 shares to you at a certain price, in our example, it was 250. Selling a call means that you're obligated to sell 100 shares at a certain price. Okay? So, for example, on September 21st, if I were to sell this call, I promise that I'm going to sell my 100 shares at 250 to whoever is on the other side of that contract. That's what that means. All right? Let's go back to my sketch graph. So neat. Oh, what am I doing here? All right, perfect. Okay, so if this is the stop and this is 216, beautiful writing. And let's say this is 250 and the stock closes above it. I have to sell here my shares no matter what. Now I collect that 5 cents premium, right, per share, which equals $5 total if I manage to find somebody, okay, that wants to buy it from me. So I would collect that $5 and then I would get all the gains from here to here. All right, I would collect that on my 100 shares. But anything higher than that, I forfeit. Right? You guys get how this works so far? The other guy gets it, all the upside from there. So now we've talked about buying and selling calls. Now let's go into puts. All right. What does it mean to buy a put? So let's use the same deadline here, September 21st. Buying a put means that you are betting basically that the stock is going to go down below a certain price, okay? What you're purchasing is somebody else's obligation, right? Somebody else's promise to buy from you um, the shares at $2.50. That's what that means. So if the stock happens to be below that, let's go to this handy tool again. If the stock happens to be below that, So let's say here's the stock. It reaches 250 and then it drops all the way down. Okay, so it's 216 now. I'm drawing it again. This is, let's say it reaches like 255, 50, all right? Okay, so, and then it ends up over here below 250. So at this point, you know, on September 21st, the stock is, let's say, at $2. Somebody has to sell it to you at 250, and then you can just, you know, buy it up again at $2. All right, and obviously you can see how this works. You collect the difference here, right? And this is like a lot of downside potential, right? So you can make a lot of money on if you purchase put. More upside, obviously, if you purchase calls. But anyway, so if you think the stock is down, the simplest way to short it is to purchase a put from somebody, and that's how this works. Now, on the other hand, selling a put requires collateral, just like selling a call. Whenever you're selling something, you better put something up, right? That's what Robinhood wants from you. You can't naked short, you can't naked sell on Robinhood, which I think is, it's very noob friendly. Um, now other brokerage houses will let you do that, especially if you have a big account. So selling a put, what that means is you take the other side of that trade, all right? So you are promising someone to purchase their shares at 250, all right? And they pay you for that, right? They pay you. So over here you see we can collect $38. That's huge. We can collect $38, but let's see if it's all right, look. So people are asking 50 cents per share, so $50 or $25 people are willing to pay. Okay, so if I was a seller of this put, I would, probably need to put up like 25, 30 cents per share here. I'm sorry, that's what I'd be collecting basically, so not very good deal at the moment. But you know, so if we take that graph again, what you're doing basically is this. You have to have the cash, all right, 250. It asks for you for $250, okay, because it's 100 shares, and it's your collateral in case this option exercises, and you need to purchase this 100 shares from somebody, no matter what the price is, right? It can be $1, okay? You still have to purchase it at 250 at that date over here. That's what selling a put option is. All right, you're obligated to do that. It's going to automatically exercise, and this is what's going to happen. Okay. Now the premium you're collecting is, like 25, $30 for that. All right. Now, I mostly sell. Okay, I mostly sell options, but I will buy when I think that something's going down. For example, I'll buy some put options or something going up, and I don't want to. Either I don't have the capital or I don't want to put it up. But in general, I mostly sell things. So it's kind of a slow grind. You collect small premium and then you just wait for a long time. Okay, so those are the four types of options here. Now it gets quite a bit more complicated, especially if you want to run numbers. There are websites that you can actually run all the numbers and all the probabilities. It gives you like a rough estimate over here. All right, Robinhood gives you the Greeks and stuff like that. Gives you the open interest. So you can make some implied volatility. You can make some calculations based on that, and it gives you even a chance of profit. All right, it does the numbers for you, but You got to judge for yourself whether you're going to win on that trade or not. All right, oops. Okay, well, that is that. So let's go back to window. Okay, perfect. All right, guys. Well, that's been the options. I'm really excited about tomorrow, see how the market goes. Maybe XK will get a pop. Just mainly trading that because it's my favorite thing to trade. Everything else is, I don't pay as much attention to it. And I'll take you more in depth through this portfolio later and tell you my reasoning for buying all this stuff. Um, it seems a bit random, this collection of stocks, but it's not that random. There's reasons behind the madness. All right. Well, with that said, guys, ready to head to bed. I'll see y'all tomorrow. Peace.